Okay, dear AFM students, in today's class, we'll be discussing a question on risk management, and that came in March 2026 pre-scene mock. And primarily, that question is on two areas. One is interest rate swap, and another is collar hedge, which you can also see the background, which says interest rate swap and collar hedge. If you a little bit recall, whenever there is an interest rate swap between two organizations, then you will see that one organization is having a better credit rating than another company. Of course, a company which is having a better credit rating, then obviously they will be having lower interest rate in floating as compared to the counterparty, as well as they will be having lower fixed rate as compared to another organization. So in case of interest rate swap, the key is one organization will have a better credit rating than another company. And how will you identify which company is having a better credit rating? Just to see the information of their interest rate, there will give you the enough information that which organization is having a better credit rating. For example, if A Limited is having a lower interest rate as compared to B in case of variable, as well as in case of fixed rate, A is having a lower fixed rate than B. So obviously, A is having a better credit rating than B. Then we start interest rate swap. And the first step of interest rate swap, student, if you recall, is very easy. All you need is just write the floating rate and fixed rate. Make three columns, name of one company, second company, and third is going to be interest rate differentials. Or simply you can write the difference. So the point is how to identify. I've just given you the hint, not a hint, I would say just a recall of interest rate swap, little bit how to start. Collar hedge, students, when we say collar hedge, never make mistake in collar hedging strategy. First of all, in case of collar hedge, you need to identify which your organization is the borrower or a lender. Because in case of borrower, you will buy put option and sell call option. An objective of collar, we know that, is to reduce net premium. If you are the lender in the question, then we are going to buy call option and sell put option. The option which I'm going to sell, I'll be receiving a premium on that. The option which I'm going to buy, I'll be paying a premium on that. So I'll net off both the premiums, payable and receivable. So net either is going to be payment or receipts. Most of the time it is net payment, but it's not a hard and fast rule. But normally it happens. If I look at the past paper, most of the time net payment comes when we are selling one option and buying another option. So this is about collar hedge. If you are a borrower, you are going to buy put option, sell call. You are a lender, you will buy call, sell put option. One more thing about the prices. If you recall your regular classes, so put will have the lower price and call will have a higher price. So now let's start the question. And this question came in March 2026 pre-scene mock of AFM. Okay, it's here. Let's just a minute. I hope students, all of you can see the question. Yes, sir, you can see the question, and we love the background of your class today. That's what to say. Okay, let's read the requirements. And student, don't forget question 1 of pre-scene mock March 26. We have done the way back. Let's read the requirements. Calculator. Obviously, you people will be solving on spreadsheet. You don't need calculator. Calculate in terms of percentage. Wow. They're saying calculate, but in terms of percentage, the results of the hedging strategies that are being considered for 36 million loan. If the central bank base rate increases to 4.4%, if the base rate becomes 4.4, base rate is like a LIBOR. If the LIBOR becomes 4.4%, your calculation should demonstrate the rates at which payments between the counterparties should be made. 11 marks. So far, at least point number A, the requirement says we are going to take loan of the amount is 36 million. If the base rate of bank becomes 4.4, you need to demonstrate. But we have to now read the question, data, exactly which hedging strategy we need to follow. It is not mentioned in the requirement. B, comment on the result of your calculation in A. Discuss advantages and drawbacks for Stoke-Wake Company of interest rate swaps compared with the traded collar. We'll be comparing interest rate swap with collar, advantages and disadvantages, including a consideration of risk involved and the risk which you are facing, 9 marks. Now listen, before we start, we need to discuss what are the advantages and disadvantages. So we are going to compare interest rate swap with collar. Let me read the question, then I'll tell you. Professional skill marks will be awarded for demonstrating the skill in analysis and evaluation. Student, I think I've said many times in our regular classes as well, the way you are solving the question, so markers, by looking at your answer, markers should get the impression that you know what you have done it. You know the data very well. That is analysis and evaluation. Skepticism, it's very simple. If I'm hedging for the interest rate rise, there's no guarantee that interest rate will definitely going to rise. It can fall. Skepticism. Commercial acumen is very simple. If I have choices of hedging for more than one, obviously I'll opt that hedging strategy which gives the result which is in my favor. In case of borrowing, I'll go for a lower rate. In case of lender, I'll go for a higher rate. But to get the professional marks, you're not supposed to do anything additional. You just solve the question properly. The following exhibit available on the left-hand side of the screen provide information relevant to the question. Stoke-Wake Company's risk management, hedging interest rate risk. Let's see. Stoke-Wake Company is a large cosmetic company. Wow. Its treasury department uses a variety of derivatives regularly to manage interest rate and commodity price risk. Fine. Stoke-Wake Company's chief executive has been considering how the treasury department uses derivatives. She understands that the purpose of derivatives is to hedge risk and wants to be sure that using derivatives avoid financial risk as far as possible. Of course, we'll try our best that from hedging, you try to minimize the risk. Today's date is 1st April. Now, this is very important, students. For example, if I need to calculate basis, so I need to know what is the date of today. So today is 1st April. They're not making you April Fool, please. Some of the students, they doubt even on their examiners as well. 1st April, sir, they have written 1st April. They're making us April Fool. They're not making you April Fool. It's a question. Today's date is 1st April. Stock-Wake Company plans to borrow an amount of 36 million. So it's a scenario of borrowing 36 million on 1st September. Now stop. The transaction date is 1st September. We're not going to take the loan today. Today's date is 1st April. Company is planning to take the loan on 1st September. Wow. After how many months? April, May, June, July, August. It's going to be after 5 months. To finance a major product development, this loan will be for a period of 5 months. So they'll be taking a loan for a period of 5 months. Okay. Although in recent years, Stock-Wake Company has borrowed for a period between 1 and 3 years. Normally, don't forget one point, and you should be mentioning that as well. Normally, swaps are for a longer period of time. But I mean, when we talk about the traded collar, traded options, so obviously that is for a short term. Here, the time period I can't see is a long period, just a 5 months period. Stock-Wake Company's treasury department, department has decided to hedge the risk associated with this borrowing, as there is some uncertainty about how interest rates will change. over the rest of this year. The current central bank base rate is 3.9. It works like LIBOR. Most prediction in the media suggests it could rise by 0.5% by 1st September. I like this. To be very honest, we are the borrower in this question. Obviously, borrower faces a risk of rise in the interest rate. Logically, borrower does not face a risk of fall in the interest rate. Fall in the interest rate could be is definitely going to be beneficial for the borrower, and that is not a risk. Someone should be, if someone is a borrower, I think that company should be praying that in the future interest rate should fall. They will get the benefit. So logically, we are the borrower and we actually face the rise in the interest rate. That is our risk. And I'm really, I would say, very happy to see, I'm glad to see that examiner is just focusing on the rise of interest rate. Interest rate could rise by 0.5%, although there have been a couple of predictions that certain central bank base rate will fall. Okay. Stockway company can currently borrow funds at a floating rate of central bank base rate plus 60 basis point. That is like base rate plus 60 basis point. That is their floating rate. Stockway company's treasury department is considering hedging the interest rate risk by using an interest rate swap arranged through a Stockway company's bank. This is very important. That there's interest rate swap option is available through a bank. Okay, that's very good. Why it is good, I'll explain you. Instead of bank, if you go to a counterparty directly, then it means you face the risk of default of counterparty as well. Here it is through a bank. So obviously now you will not face that risk. I'll explain this point later on more. A caller on the options on interest rate futures swap. Stockway company's bank has found a possible counterparty. Bank has found, not us. It means something goes wrong, that a company, that counterparty defaults. The default risk of counterparty does not fall on us because we are not the one, we have not found the counterparty. Who has found the counterparty? Bank. So bank will take care of each and everything. If something goes wrong, counterparty is unable to make the payment, something like that. So bank will have to look after that, not us. Obviously, by bringing the counterparty for us, arranging the swap, bank is going to charge the fee. But the good thing is, we are not directly basically involving with the counterparty. We will involve with the counterparty through a bank. It's like simply you are buying a property through a state agent. If something goes wrong, so state agent is going to be responsible because you rely on a state agent. So same thing is happening here. We are not going directly to the counterparty. Bank is the one, they are arranging that counterparty for us. Stockway company's bank has found a possible counterparty for a swap with a Stockway company. The counterparty can borrow at an annual floating rate plus 140 basis point. Straightforward, you can see that the floating rate for the Stockway company is base rate plus 60 basis. Counterparty can borrow at base rate plus 1.4, 140 basis point. It means as far as floating rate is concerned, we are better. A fixed rate for the counterparty is 5%. Stockway company's bank has quoted annual fixed rate 4.7 for its borrow. Now stop. Student, now you should be able to identify here that Stockway company is having a better credit rating than counterparty. How? You can see that Stockway is having an advantage in floating rate as well as they are having an advantage in fixed rate as compared to the counterparty. Stockway can borrow in floating rate, and the rate which is for the Stockway is base rate plus 60 basis point. On the other end, counterparty base rate plus 140 basis point. Fixed rate of a stock company is 4.7% and fixed rate of counterparty is 5%. So clearly we can see that one thing, that Stockway is definitely having a better credit rating than counterparty. The bank would charge a fee of 10 basis point to each party individually. So the total fee is going to be 20 basis point because 10 basis point will not be charged on the entire arrangement. It will be charged to each party. Intermediary of the swap, both parties would share equally the potential. Whatever the benefit comes due to swap, it will be shared equally. So let's start first with the interest rate swap. Interest rate swap is a swap arranged through a Stockway company's bank. The counterparty can borrow at base rate plus 1.4, 140 basis point. Counterparty can borrow at base rate plus 140 basis point. Fixed rate of a stock company is 4.7%. And fixed rate of counterparty is 5%. So clearly we can see that one thing, that Stockway is definitely having a better credit rating than counterparty. The bank would charge a fee of 10 basis point to each party individually. So let's start first with the interest rate swap. Let's just start with the swap. If you recall, student, the first step is just write the name of the companies and one more column for the difference. Stoke, Wake, counterparty. Either you write interest rate differential or difference is the same thing. Floating rate. Stock Wake is can borrow at base rate plus 60 basis point means 0.6%. Here it is base rate plus 140 basis point means 1.4%. If you calculate, just there's no need to write positive, negative. Simply, I've just written the rates. If you take the difference, logically the difference will be 0.8%. Don't go into positive, negative. We are just writing the difference. Base rate with the base rate will be cancel out, and 1.4 and 0.6, the difference is 0.8. Okay. Fixed rate, 4.7% and 5%. Difference between 4.7 and 5 is 0.3. Now, student, what you need to do? Now you have to take the difference of differences. If we take the difference of differences, you will get 0.5%. That's a benefit. But this is the benefit before the bank fee. Benefit before bank fee. It will be shared equally. That is, each party will get a benefit of 0.25%, which is before the bank fee. If someone deducts the bank fees here, so perfectly all right. Otherwise, you can deduct the bank fee later on towards the near to the completion of interest rate swap. But someone deducts here, that's perfectly fine. I've written bank benefit before bank fee. Okay. Each company's benefit is 0.25%. Okay, now look at the data properly. Of course, we have already decided by looking at the data, Stoke company is having a better credit rating than counterparty. There's no doubt about it. Okay. Now the question is, now the step has come, we have to go for actual borrowing. Now for actual borrowing, student, you need to decide where is Stoke company is having more advantage as compared to the counterparty. Of course, Stoke is having a better credit rating. Stoke is having advantage in fixed as well as in floating rate. But if you look at the floating rate, Stoke company is having more advantage in floating rate as compared to fixed. Stoke is having advantage in fixed as well as in floating rate. But the larger advantage Stoke company is having in the floating rate, which means that Stoke will borrow in floating rate. Stoke Wake company is having larger benefit in floating rate. Fine. Stoke Wake counterparty. Now, students will go for actual borrowing, and Stoke Wake is having more advantage in floating, so they will borrow in floating rate. Actual borrowing cost. Actual borrowing cost or actual borrowing is enough. Just a minute. Actual borrowing. Stoke Wake will go for floating rate, that is base rate, plus 0.6%. So obviously counterparty will go for fixed rate. Now listen, student. Step 2 is we have to make this floating rate payment 0, which means counterparty will make payment to Stoke Wake. Counterparty will pay to Stoke Wake. Base rate plus 0.6%. Logically, base rate plus 0.6% is an outflow for Stoke Wake. Now the same thing becomes inflow because counterparty is making this payment. So logically, this will become 0. You are not supposed to cancel out. Here, for counterparty, it is an outflow. Base rate plus 0.6%. Now, of course, Stoke Wake will have to pay in the fixed rate to counterparty. Now, but listen carefully, students. Stoke Wake company will pay to the counterparty in the fixed rate, but before making any payment to counterparty, Stoke Wake will deduct its benefit from their own fixed rate. The company which is required to make payment in fixed rate, what that company is required to do, first, that company will take their own fixed interest rate, and from their own fixed interest rate, they will deduct their benefit. And whatever is left, they will make the payment. Here, Stoke Wake company is required to make payment in the fixed rate. So what Stoke Wake is going to do? Number one, Stoke Wake will check what is their fixed rate. Second, they will deduct their benefit. And whatever is left, they will pay to the counterparty. So Stoke Wake pays to counterparty. Just a minute. Counterparty. Stoke Wake fixed rate is 4.7%. The benefit we are deducting is 0.25. And we know that this benefit is actually before the bank fee. So 4.7 minus 0.25, students, I'm getting 4.45%. Outflow for Stoke Wake and counterparty, for counterparty, it is an inflow. Here comes the borrowing cost, but before bank fee. Borrowing cost before bank fee. Here I'm getting 4.4%, 4.45. Now listen, student. We are having 5% outflow, 4.45 inflow. So logically, the outflow is 5%. Inflow is this. How much outflow will be left? 0.55 outflow will be left. This 0.55 will increase base rate plus, because base rate plus, when we are adding something to the base rate, it increases the cost for the counterparty. So 0.55 will increase the cost for the counterparty. The answer is base rate plus 1.15. But the story does not end here. Now we have to deduct the bank fee. Bank fee, each company will be paying 0.1%. So here comes overall borrowing cost. 4.45 plus 0.1, I'm getting 4.55. Here it will be base rate plus 1.15 plus 1.25. So overall borrowing rate for Stoke Wake is 4.55, and for the counterparty it is base rate plus 1.25. And student, let me tell you one thing. Kindly follow the presentation which I have taught you in our regular classes. Some of the students, what do? They, by looking at the presentation of examiner or by looking the presentation of examiner, examination team, or suggested answer, they just get confused. Even though you will get the same final answer which they are getting it. So I would request follow the, I would say, sequence steps which I have taught you in our regular classes, rather than by looking at the answer of examiner and getting confused. So this is what you need to do. But at the end of the day, don't worry. Your result, final answer, and the examiner final answer will be definitely same. It is not going to be changed. Okay. This was interest rate swap. A sort of revision, I would say. Caller. Don't forget, if today's date is 1st April and transaction date is on 1st September. Actually, company will take the loan on 1st September. Options on 3 months September dollar future. Examiner is very nice towards you. He's not giving you more different dates of option, which could have created little bit problem for the students for deciding which month to take. So here, obviously, the logical is September, and examiner has given us a September. September future, contract size is 1 million. If I've been given a contract size and examiner does not give me the tick, I would say tick value, I can very easily calculate. I have no issue at all. Option premiums are in annual percentage. Strike price is 96, 95.5. Students, when we say collar hedge, in case of borrower, we buy a put, we sell call. We buy a put at a lower price, we sell call at a higher price. When you're going to, and this is the premium of call, obviously we are the borrower, so we'll be selling the call, so I'll be receiving this premium. We will be buying the put, so I'll be paying this premium. You can see that the premium which the stockbreaker is required to pay, it is more than the premium which they are going to receive. Logically, there will be net premium payment. And net premium payment, they have not given us a tick value. We can very easily calculate. Contract size is 1 million, 1 upon 10,000 and 3 by 12. Logically, it has to be 25 if I'm not wrong. Tick value is 25. Okay. Let's see. The current 3 months future price for September, they have given you the future price. The question is, sir, why they have given us a future price? If you recall, either will you be exercising the option or the counterparty will be exercising the option. Each party will compare their exercise price with the future closeout price. That is why examiner has given you the future price, that by using this future price, first you have to calculate future closeout price. Okay. Futures and options contracts assumed to settle at the end of each month. Basis is assumed to diminish to zero at contract maturity at constant rate. Based on a monthly time interval, it is also assumed that there is no basis and there are no margin requirements. Basically, when we say it is assumed there is no basis, means the future closer price which you have calculated, when the time comes, it will be the same price. Or practically, it is not the case. Practically, you will face the basis risk. Facing the basis risk means the future closer price which we have calculated, predicted, when the actual time comes, the transaction date comes, on that day, of course, the future price will be different. It means the company practically is going to face the basis risk. But here, obviously, we'll be assuming that we are not facing any basis risk. Not facing any basis risk means the interpretation is whatever risk, whatever future closer price we are going to calculate, when the day of transaction comes in the market, the future price will be same. That is the interpretation of not facing any basis risk. Now, students, let's just start, I would say, hedging strategy, but I need this data. Okay, collar hedge, collar hedge, collar hedge, collar hedge. Hedging strategy. Buy September put option. and sell September call option. Okay. We are buying the put option. We are selling the call option. Put option will have a lower price. Call will have a higher price. Let's just mention to the examiner there's no harm at all. Okay. Put option. Exercise price 95.5. We put low, call is high. Call is 96. Call option. Exercise price is 96. I'm just calculating tick value. They've not given me that tick value. Tick value is 25. Okay. Now, first of all, student, we need to calculate future closeout price. Without future closeout price, we cannot solve the question any further. So let's calculate basis first. Spot price 100 minus LIBOR. If you read the question, today's base rate is 3.9%. Let's go. Let me show you where is this 3.9. I've seen somewhere. Yes, here. Current central bank base rate is 3.9. So 100 minus 3.9 is 96.1. Future price, they have given us the September future. Don't forget, student, this. September future price is 95.62. And contracts, they mature at the end of the month. 95.62. 95.62. Difference. We can see one thing here. Spot price is higher and the future price is lower. 96.1 minus 95.62. Students, I am getting 0.48. Now listen to me carefully. Today's date is 1st April. Transaction date is on 1st September. And the future, 95.62, the future matures on 30th September. Examiner has given us the 30th September future. Logically, the future which is matured on, which is going to be mature on 30th September, we will close that future on 1st September. 1 month before, I would say, maturity, we will close this future. Why? Because the transaction date is 1st September and future matures on 30th September. So how month earlier we will be closing the future? 1 month. So 1 month basis will be unused. Second, 1 month basis will be unused out of 6 months. How did I calculate 6 months? Today's date is 1st April and you have chosen the 30th September future. If you count the time period from 1st April till 30th September, the total time period is 6 months. April, May, June, July, August, September. So the total basis 0.48 is actually representing 6 months time period. Only 1 month basis will be unused out of that. Why? Because 30th September future will be closing this on 1st September. So let me just write unused basis. 0.481 upon 6. I'm getting 0.08. Now listen, student. By using by using these unused basis, we will calculate future closer price. Repeat. By using unused basis, we will be predicting future closer price, and it is mentioned in the question on transaction date base rate becomes 4.4%. So simply to calculate future closer price, excuse me, on 1st September. Base rate becomes 4.4, it is written in the requirement. Spot price will be 100 minus 4.4, 95.6. Now listen, in day one, spot price is higher, future is lower. So the day we are calculating the future closeout price, on that day, we follow the same trend. On that day also, spot price will be higher, excuse me, future will be lower. So we'll deduct unused basis, less unused basis. 95.6 minus 0.08, we are getting 95.5. Future closeout price. Now, students, things are very simple. We have, of course, we're dealing with the collar hedge. Let's go for the collar hedge. Put option. We buy the put option. We have sold call option. Exercise price. Now we have to check either we are exercising the option or not. Exercise price is 95.5 and 96. We'll compare these exercise prices with future closer price. Future closeout price. 95.2, 95.2. Now listen. Put means right to sell. We can sell at 95.5. If we are selling at 95.5, then we'll be buying at 95.52. So I will not exercise the option. Why? Why would I? If I have an option, I can sell at 95.5. Then I'm going to buy at 95.52. I'll be having a loss on exercising the option. When there's a loss on exercising the option, so I will lapse it. We are the buyer. So will you be exercising the option? No. We are not exercising the option. Now, sir, we have to see the counterparty. Either they are exercising the option. If the counterparty exercises the option, logically the gain for the counterparty is loss for us. Why loss for us? Because we are the one they have sold call option to the counterparty. Now listen to me carefully. Forget that you have sold the call option. Just listen to me carefully. Call means right to buy. Just focus on right to buy. Leave the counterparty. Just focus on one thing. 96. Let's say you can buy at 96. If you're going to buy at 96, then you'll be selling at 95.52. Just focus on call. Forget right now that you have sold it. Call means right to buy. Let's say if you can buy at 96, if you're going to buy at 96, then you will be selling at 95.52. So obviously, I will not exercise the call option because I'll be having a loss. So when you are not exercising the call option, so logically the counterparty will not also exercise this call option. Why would they exercise the call option? Because if they buy at 96, they will be selling at 95.52. They will be having a loss on exercising the option. So either party will only exercise the option when they are having a gain on exercising the option. Now, students, things are very simple. Let's calculate actual interest, actual borrowing cost. The loan amount is 36 million. Now, listen to me carefully, students. Base rate on 1st September has become 4.4%. But my company, Stokewake, when we'll be taking a loan, we will not take the loan is not available to us at base rate. Loan is not available to us at base rate. Loan is available to us at base rate plus 0.6%. I've mentioned in my regular classes also many times that CRP, the plus base rate plus LIBOR plus, the plus issue, the basis point issue, the plus issue only arise, you will take that plus, uh, which increases your interest rate only when you are calculating actual outcomes. Now we are calculating actual borrowing rate, actual borrowing cost. Base rate is 4.4, but we will not get the loan at 4.4. We will be getting a loan at 4.4 plus 60 basis points, which makes this 5%. I'm just writing here 4.4% plus 60 basis point. This is how we are getting 5%. Time period of borrowing is 5 months. It is mentioned in the question. So 36 million. I'm getting 7,50,000. Okay. Now we have to calculate the net premium which we have to pay. But before that, let us calculate the number of options which we have not calculated, I believe. We have not, let me calculate here. Number of contracts, 36 million. Contract size is 1 million. Time period of borrowing is 5. 3 is a pure fact, which I have mentioned many times. Number of contracts we are getting 60. What is the benefit of the 60? I'll tell you. Net premium will be paying it. Why will be paying the net premium? Because premium payable is more than the premium which will be receiving it. So net premium payment. We will be paying premium percentage. Oh, wow, wow, wow. Where is the premium? We have to go to the question. We will be paying 0.234 on put option. We'll be receiving 0.219 on call option. So difference we have to pay. Premium payable is 0.234, receivable is 0.219. Multiply by 100 so that we can calculate number of ticks. Multiply by number of contracts into tick value, which is 25. So let's see. Student net premium, let me recheck. 0.234 minus 0.219 multiply by 100 into 60 into 25. Student net premium payment is I'm getting 2250. Here comes your overall borrowing cost. 7,52,250. This is your total borrowing cost. But the story does not end here. We have to calculate annual effective annual rate because it is mentioned in the requirement that you have to, your answer has to be in percentage. Effective annual effective interest rate. Okay, let's take this 7,52,250 divided by 36 million. 12 upon 5 into 100. Oh, just a minute. Students, I'm getting 5.015%. Now let's see what was the rate in case of swap. So look at the swap. We are getting 4.455. So obviously swap is better than collar. Interest rate swap is better than collar hedge due to offering lower fixed interest rate than collar hedge. Okay, now student, if you go to the next requirement, I just want to say one thing. So whoever has seen properly regular classes should not be having any issue in this question. Okay, comment on the result of your calculation in A. Yeah, your calculation should be this, demonstrate this. And discuss advantages and drawbacks. Okay, B says comment on the results of your calculation in A. So in the B, I'll be writing interest rate swap is better than the collar. Okay. Discuss advantage and drawbacks of stock company of interest rate swap. Now stop, compared to collar. What are the advantages in case of interest rate swap? Number one advantage is obviously interest rate swap is obviously offering a lower fixed interest rate than the collar. That's a benefit. There's no doubt about it. But listen to me carefully. In case of interest rate swap, Stokewake will actually convert their variable interest rate to the fixed rate, which means that they will be converting, they will not be facing the uncertainty risk relating to rise in the interest rate, which they do in case of variable rate. Once your variable rate is converted to the fixed rate, so certainly with certainty, stock company will know that how much interest they have to pay. And this is not the case in case of collar hedge. If you check, when we were calculating students collar hedge, we finally actual borrowing cost, we were taking a floating rate, 4.4 plus 60 basis point. The one of the advantages in case of interest rate swap is interest rate swap here for Stockwake is eliminating the uncertainty which Stockwake could have faced in case of floating rate loan, because under interest rate swap, floating rate is converted to fixed rate, which gives Stokewake a certain amount which they have to pay. That is one of the advantage, and this is not the case in collar hedge. Collar hedge still they'll be taking loan in floating rate, so that is an advantage. Another advantage, of course, you can say that interest rate swap right now is having a lower cost than collar. Okay, fine. Another advantage is interest rate swap is an OTC product, over the counter product. It's an OTC product. Due to OTC product, it is tailor made for us. Exactly for how many months what we need, we'll get it. But when we say collar hedge, in case of collar hedge, there's a possibility of under or maybe overhedge. Even though under and overhedge, they are not going to create any significant problem for the company, but still you will be facing that. But in case of interest rate swap, you will not face any under overhedge problem. Under overhedge problem could be faced by the Stockwake company in case of collar hedge. So that is another advantage in interest rate swap. It's an OTC product. You will not be facing, Stockwake will not be facing any under overhedge issue. But when we say collar hedge, yes, there's a possibility you might be facing under overhedge issues. Even though that under or overhedge will not create a significant problem for the Stockwake, but still. Now let's talk about the disadvantages. If I go for interest rate swap, what are the disadvantages? Number one disadvantage in case of interest rate swap is it's a contract. It's going to be a contract between you and the bank, which means that you have to fulfill. Another point is, one, I have to fulfill. Means I don't have any option of lapse and just leaving it going and leaving it without fulfilling the contract. You can't do that. In case of collar hedge, you have the option of lapse. Here you don't have that option. Plus, another disadvantage in case of interest rate swap is under interest rate swap, interest rate becomes fixed for you here, which means that in the future, if the interest rate falls, Stockwick will not be able to get the benefit for that, which is available under collar hedge. It is not available in case of interest rate swap. So these are the disadvantages. But of course, we cannot, when we say in interest rate swap, there's one more disadvantage. If the counterparty defaults, you will be facing the risk of default. But that risk actually Stockwick will not face here, because Stockwick is not arranging the swap by themselves. It is through a bank. So mainly there are two, I would say, disadvantages. One, it's going to be a binding contract. You have to fulfill interest rate swap. There's no option of lapse, which is available in case of collar hedge. Plus, you won't be able to get any benefit. Stockwick will not be able to get any benefit if interest rate falls. Under collar hedge, that benefit is available. So students, if you have written around 2 to 3 advantages and disadvantages, of course, you are comparing interest rate swap with the, I would say, collar. This is what you need to write. Okay, I'll do one more thing. Let me discuss the part B, what examination team has written. So in this way, you will have more clear, I would say, understanding of each and everything. Okay, so here comes the answer. This is the answer of interest rate swap. I think we have calculated the same thing. Then collar net premium we calculated. Presentation could be different, but obviously the both options are not, we are not exercising. We calculated annual interest rate 5.015%. Actually, with the rounding off, they have made it 0.2. Okay, comments are here. Advantages. Advantages of swap. Stockwick company is swapping here commitment to a pay variable rate of interest that is uncertain with a guaranteed fixed rate. I think we have covered this point. Of course, the volume which examiner is producing, nobody is expecting from you to produce the same volume, but that point is covered. You have actually converted your variable rate to the fixed rate. A swap is OTC product. We have discussed that as well. Collar is not an OTC product. Okay, now let's see the disadvantages. Swaps are subject to counterparty risk, but here it is not the case. The risk that other party to arrangement may default on arrangement. This should not generally be a problem if a Stockwick company arranges the swap through its bank, as is the case here. It may, however, be a problem if it arranges the swap itself. They are not doing it, so there is no point of mentioning. As the option that the collar is based on traded derivative markets, the regulation governing these markets should guarantee there will be no counterparty risk. As a Stockwick company is swapping into fixed rate commitment, there's a risk that it will be committed to higher interest rate. There's a possibility. See, if the interest rate actually falls, you won't be able to get the benefit and you end up by paying, because fixed rate means you will be paying that rate particular. There's a possibility in the future if the interest rate falls, you will end up by paying more interest because fixed rate is higher. Stockwick companies swapping into fixed rate commitment, there's a risk that it will be committed to higher interest payment than it could have been. It cannot take advantage of favorable interest rate changes as it could to some extent if it use collars. As swaps are over-the-counter instruments, they cannot be traded or allowed to be lapsed. We have covered that point also. So students, you can see that these are the results. I've just shared the answer as well. So student, again, I just want to say, of course, advantages, disadvantages, which I have explained, even you write that in your own wordings, that's perfectly fine. 100% fine. Interest rate swap advantages here, which we have discussed. Number one was in advantages. The number one was that Stockwick, they have actually converted their variable rate to the fixed rate, which means that under variable rate, there's an uncertainty that interest rate could increase and they end up by paying more interest, which is now eliminated. That's a benefit. You will be paying a fixed rate. Another point is interest rate swap is an OTC product available from banks. It's a tailor-made product. Means there is under interest rate swap, you will not stock wake company will not be facing any risk of under overage, which under collar hedge there's a possibility you might be facing under overage issue, even though that under overage issue is not going to create any significant problem, but still there's a possibility you might face that, and you will not be facing this in case of interest rate swap. That also goes in the favor of interest rate swap. It's a benefit which goes in the favor of interest rate swap. Disadvantages, of course, once it's an OTC product available from banks, you have made an agreement, you cannot lapse. In case of collar hedge, you can lapse it. Because but as far as when I'm saying you can lapse, so you can lapse when it says when you are a borrower, you bought the put option. You have the option. You can, if you want, it is up to you. Either you are exercising the option or not. So, but that option is not available under interest rate swap. Another problem is under interest rate swap, here you will be paying the fixed rate. There's a possibility that in the future interest rate falls, and you might end up paying more interest because you will not be able to get benefit due to favorable movement in the interest rate. So this is good enough. They have written the counterparty part that under interest rate swap, you might be facing a risk of counterparty default if that company is unable to fulfill their commitment. But that is not the case here because Stokewake is arranging this through a bank. And of course, when I'm doing collar hedge, I'm not facing such risk at all. Collar hedge is through traded options. So governing bodies, I would say the markets, they make sure that you should not be facing any counterparty default risk. So this is all about students. AFM, pre-scene mock, question 3. And mainly that primarily I would say that question was on 2 areas. One is interest rate swap, another is collar hedge. And here we were the borrower. So thank you very much, students, for watching this lecture. Still you have any confusion, you have any queries, you can always ask in your relevant WhatsApp groups and I love to reply.